Today, folks, I have been getting incredibly aggressive this week buying two tech companies, Google, Tesla. We're going to break that down as I look forward to obviously buying some of these Canadian, beautiful, wonderful dividend payers that I think are sitting at some discounted levels. We're going to discuss some of that in my $230,000 Canadian stock portfolio. If this is a conversation you'd appreciate on your path to financial independence, come join me by hitting that like button and subscribe button while you're down there. But getting into it, yes, my portfolio has been scaling primarily with these two companies as of recently, and I want you to keep in mind that in tandem to my fiance's portfolio to continue diversifying our combined asset values, I don't want to just keep putting money in the same tech companies, and Google and Tesla are something we lack, and I think they're the most discounted tech companies this year, and I'm going to discuss why in this video. But I picked up about 39 shares of Tesla in total. I bought a lot of it this week. Google, I'm still sitting at around 68 shares. They're combined making up about 10% of my portfolio today. I've lowered my cash position to about 10 grand. I'm always going to keep a little bit of cash in case the markets decide to crap tank for whatever reason. I always want to be able to have a little bit of aggressive buying power, which is nice to have, with some dry gunpowder there. But you take a look, and I'm buying a lot of these companies in my tax-free savings account, and a lot of people are kind of getting upset about this. They're saying, oh, but if you're taking on all this risk in your TFSA and these stocks go to zero, you'll never get that contribution room back. Now, I'm not buying crap companies or penny stocks that are a lot more volatile and risky. I'm buying, really highly valued companies with great balance sheets that, again, I believe are at a discount. But keep in mind that I'm always buying the S&P 500 in tandem. I bought a bunch of S&P 500 this week as well. But the thing is I have $170,000 worth of room in this account that's tax-free in perpetuity for the rest of my life of contribution room. So even if I put $50,000 at risk in highly volatile companies and they go to zero, I still got $120,000 worth of room here. I mean, this is all because I picked great companies over the last 8-9 years I've been investing, things like Apple and Microsoft, and I sold all those companies and all my stocks to use as a down payment tax-free for the piece of real estate we bought last year. So I could see myself scaling Tesla probably to about a 20 or 30K position. Google, maybe about 15 to 20,000. I'm not going to be as aggressive. I think Google has the most short-term potential upside, but I think Tesla has the long-term potential upside that is going to surpass Google from the current values that I'm seeing. And I'm going to break this down, and I'm also looking at buying some Canadian banks in here, which we will discuss the latter half of this video. But let's start with the tech companies, because it continues to be a week of crapping on Google, which I love, because if you could go back 10 years ago and say, hey, there's going to come a time in the future where Google's going to lose $100 billion in market cap value because it couldn't generate the historically white versions of German soldiers and like other historical things, but meanwhile their AI is better than ChatGPT and so many of these other softwares that are out there. And on top of that, I've been hearing investors say they're never going to allow self-driving. Self-driving is going to take years because of regulation and blah, 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 blah. Meanwhile, Google's approved in 4 states and they have hundreds of vehicles self-driving on the road today. They are the leader in that industry. Now, that company Waymo is losing billions of dollars for them, but I think step a decade into the future, and as that company scales, I'm going to be very impressed to see where it trades in tandem when Tesla gets their shit together and starts actually getting self-driving off the road. Now, it's funny because analysts are saying, hey, hold your horses, says Bernstein about Alphabet stock. Those woke people out there, they're going to lose money. Meanwhile, Google here is trading at double-digit revenue growth, and net income is continuing to scale. So honestly, keep complaining about Google because you're setting up a beautiful buying opportunity that I think only the likes of Motley Fool have started to recognize as they add it to one of their 2 AI stocks that have 29% more upside. And honestly, Google should be trading at a 30 times multiple, just like the rest of the mega cap tech companies that are also AI forwarded like Microsoft. But hey, that's just one man's opinion. I'm not a financial advisor. I'm just a clown on YouTube. Same with Tesla stock. Everyone's beating me up about Tesla. It's an overvalued car company. Okay, come on, calm down. This isn't where Tesla was 2 or 3 years ago. We're in a whole new realm of Tesla stock trading at a 46 PE, okay? If you don't think Tesla can, in the next decade double or triple up its revenues and income, then don't buy it. But I personally think it can. I mean, if you go into their earnings, I think people are largely misrepresenting that Tesla's a pure auto business. Yes, $82 billion of 2023 came from their automotive business, which grew 15% in one of the worst market environments the auto industry has ever faced. But look at energy generation, and keep in mind, Tesla's the only one generating like massive revenues off EVs. Everyone else is cutting their EVs because they can't afford to do them profitably. But you look at, Rivian and Lucid are going bankrupt here, but energy generation storage revenue is up to $6 billion. You know how big of a business that is for Tesla today? And people are like pretending like they don't even have these other facets to their business that's up 54 damn percent. Services and other revenue up 37%. I mean, these two other businesses alone are generating them a substantial 14 billion dollars of extra income a year. Now, it's nothing close to the automotive, but it's growing at a much quicker clip, right? 50% is astounding if they can continue to generate that moving forward. Now, keep in mind, I think there's so much growth in Tesla because not only are they launching apparently what's going to be the cheapest EV next year, and something tells me that's going to come in tandem with a self-driving network. I think they're going to start competing with Google because their version 12 of self-driving this year is damn near jaw-dropping, and I think it's on the cusp of finally being somewhere ready to be part of some kind of network. We'll see if they can get into the realm of Waymo here soon, but they're also going to be launching their supercar competing with BYD, and now they're claiming that they've rehashed this thing so much over the half decade everyone's been waiting for it that it's going to be able to do 0 to 60 in 1 second or less. I mean, Tesla's on the forefront of innovation on so many fields. Their branding power is astounding, and people continue to crap on this business too. And I hope they do, because I'm hoping the stock drops to about $1.50 on earnings. We'll see if they can sustain earnings. I think the hype of the Tesla bot might start to come into play this year, but I think all of that's going to be 2025. I think 2025 we start seeing the Tesla bot doing meaningfully impacting things that can actually be represented in sales to some extent. I think they could start selling or at least utilizing them in their factories. I mean, we're going to start seeing more talks around self-driving, cheaper EVs. We're going to start seeing scaled Cybertruck. We're going to start seeing the this really fun supercar, all that stuff, right? So again, if you don't think Tesla can scale from here, then don't buy it. But I think it's going to easily, 2 or 3x from where it currently sits. So I think at a 40 times multiple, that's a very fair value for where it's going to be in the next decade. I really think people are missing the mark on this one now. And again, I get it. The story of Tesla being overvalued back here in 2021, I agree. That's why I sold it. I never even started buying Tesla until now. Keep that in mind. So shit on all you want, but I think there's value here as this clown's opinion tends to resonate into the future on a pretty substantial rate of return. I mean, I haven't screwed up too bad. I know I'm being cocky. I know I'm maybe being a little arrogant here, but we'll see how. Laugh at me if I'm wrong. Just laugh at me if I'm wrong. It's fine. I put my money where my mouth is, though, unlike a lot of these clowns, and I'm transparent about it. So we got National Bank here. When I was talking about the banks over this week, I am shocked by the disconnect between what's going on with these banks and the market environment today, because they're still putting a lot of loan loss provisions aside. But what I recognize and what I've discussed is all these banks continue to hit record revenues. National Bank finally hit an all-time high. And it is still putting more loan loss provisions aside along with Royal Bank. And my wife already owns Canadian Imperial, she owns TD, she owns Bank of Nova Scotia, so I'm trying to avoid those ones, and I'm looking at picking up National Bank and Royal Bank, and this is just to continue to collect our Pokemon cards, but I think National and Royal Bank have had some of the best at over doubling of their dividends. They don't pay the highest yield, they're both paying around 4%, but I do think just to continue diversifying the pot, I'm going to be adding these to my TFSA starting probably next week or the following week. And these are just kind of the stocks that I want to continue to diversify the total of my pie here before I start buying VDY. I also want to buy TELUS at some point soon here. I think TELUS, National Bank, and Royal Bank will be the 3 starter individual stocks that I start buying along with VDY, just to continue building out the little bit of Canadian stocks to start generating some income, because I'm only getting about 2.2%. I'd like to get that up to closer to 3% at some point in the future. But again, keep in mind, the whole point of me buying tech companies in the S&P so aggressively is in the next 5 to 10 years, I'm hoping I'm in a position where we can kind of semi-retire. Well, by 40, I want to have the full capability of financial independence. But in the next 5 years, if things work out really well, I can scale down my S&P position, scale down Tesla and Google, and kind of redivert them into some really great dividend companies. And that can put me in a much healthier position to supplement a lot of our income. Again, I'm taking risk with this, but I still have a great job. I still have great income, and I'm going to be working hard. So I'm hoping these companies can help propel it a bit quicker and continue to lead to outsized returns. But I will pass that question off to you. I'd love to know what you think and what you're doing with your portfolio in that comment section below.